Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged. Thanks so much for tuning in today. I know how valuable your time is, so I'm grateful for you spending some of it here with me. I also want to thank you for sharing the podcast with your friends and colleagues. It really does help me expand the reach of the podcast so more people can learn from the amazing stories of my guests. On today's show, I'm talking to Chris Cruden, founder and CEO of Inch Capital Management. Chris has a long career working for some of the leading firms within the alternative investment business, such as Dean Witter back in the 80s and AHL in the early 90s. And he has crossed paths with many of the legends of our industry. But perhaps the biggest influence in terms of mentorship came from the years where he worked with Bob Tamizha, who helped Chris align himself with trading and how he defines himself. Having said that, Chris shares with me that all of the important things he needed to learn about trading, he actually learned in the army. When Chris decided to start his own company, he chose Currencies as his investment universe, which helps him stand out in a crowded world with diversified managers. All in all, a wealth of experiences shared by a true veteran. For those of you who are new to the show, let me just say that you can find all of the show notes, including a full transcript of today's episode, on the toptradersunplugged.com website. Now let's get started with part one of my conversation. I hope you will enjoy it. Chris, thank you so much for being with us today. I really appreciate you taking the time.
My pleasure.
Now, you've been around for quite a while, if I may say, in the managed futures industry, and at different times you work for what I would consider leaders in different areas. And let me explain that. For instance, I think of Dean Witter back in the day, where the wirehouses were a dominant force in identifying and helping some of those managers who later became legends in this part of the hedge fund universe to get started, to get their initial investors on board, and where some of the people working for Dean Witter themselves went on to become legends in their own right. Ken Troben comes to mind, for example. And then you also spent some time at AHL, which we know today has been the source of inspiration and talent for so many European managers who in some way have overtaken the US managers in the last 10 years or so. And working for these two well-known firms, that only takes you up to 1993. So I think there's quite a lot of interesting things that we can explore today. And I really look forward to hearing you sharing all of these previous experiences and bringing us up today. But I'm also intrigued about this fact that you've spent the last 20 years focusing on currency markets, which has been a prominent asset class at times, but in my view, it hasn't been so prominent, or maybe I should say it's been a bit under the radar for CTAs in the past few years, where they have chosen maybe more diversified strategies. So lots of things to discuss, Chris, but before we get to that point, I'd really like you to take us all the way back to the beginning and tell us how you ended up choosing this path in your life.
Well, delicately put that I've been in the business a long time, by the way. That's very polite. Actually, I started off as a British Army officer. I went to Sandhurst and I was commissioned into the Gordon Highlanders as a platoon commander. And when I left the British Army, I went to what was then Rhodesia. And if you follow a career path, such as I had as a very young man set out, as what they euphemistically call a contract officer, the worst possible thing happened, and that was peace was declared.
Right.
And so I found myself, and the country renamed Zimbabwe, and I found myself in South Africa without a job, but with a regimental tie. So I knocked on the door of a bank that was called Cyfrit's Trust, now part of Nedbank,
right.
And they gave me a job as a gold analyst.
Okay.
A Scottish gent there called Mr. McTaggart.
Okay.
And I said to him, well, that's very kind of you. And he said, not at all. For a young Scottish boy like yourself, we're happy to do it. And I said, but I don't know anything about gold. And he said, well, the only thing you need to know about gold is the price it sells on the market, the price that it costs to get it out of the ground, and the difference between the two numbers. Can you do that? I said, yes. And he said, well, now you're a gold analyst. So Cyfrit's used to do much of its business through Dean Witter Reynolds, and after a couple of years, I'd made friends with some people who from Dean Witter used to come over, and they said, come to see us if you're ever in the States. So I did. Sure. And they hired me, and Dean Witter, under a man called Ken Tropin at now Graham Capital, who was a visionary of his time, had started up the Dean Witter Managed Futures department. Now, in those days, there really weren't hedge funds in any sense. Right. Our sort of trading was managed futures. You never heard of hedge funds at all. It was all CTAs. And Dean Witter was very, very successful. In fact, I think we did one of the largest new offerings. It was something like 250 million. It was oversubscribed by more than 2 times. And in fact, I think we handed back more money than we raised, which is not a problem that many people have these days. After the crash in 88, I found myself back in London and was introduced to a man from Singer Friedlander. In those days, the firm was called, like many of these firms, they've sort of been consumed by a bigger bank, but Singer Friedlander, he said, I haven't a clue what you do, but I know some young guys who seem to do a similar thing, and that was Michael, Marty and David at AHL. And so I joined them, and at the time, I think we just moved to Jermyn Street in Mayfair, and of course everybody told us that you've absolutely ruined your business. You've cut your own throat. You've hung yourself. Nobody is going to go and visit you in Mayfair. And now, of course, we see that they were wrong about that as well. Sure. We had $5 million, and I think that number actually dropped shortly after I joined. I like to think the two are not related. But it dropped, and we went on and raised more money, and then did the first transaction with Man, I think, in 1990. Which was very successful. In 93, I found myself back in New York and joined with a man called Robert M. Tamizha, who was very much a guiding light for me and a great mentor for me. And we were of the opinion, this sounds really bizarre, but we were of the opinion that markets take on the characteristics of the participants, and because there were so many people becoming registered as CTAs that the markets would become crowded, easily spooked, over-leveraged, in other words, bad places to be. Sure. We looked for a market that did not have those characteristics, and the one that did not have those characteristics was the interbank foreign exchange market. Why? Well, because it was a professionals market. It was literally interbank. And so we launched our program, which in those days was called Kintyre. All of our programs, even to this day at Inch, we always give our programs a Scottish place name. And Kintyre, within a very short period of time, had attracted more money and was far more successful than the main part of Tamizha business, which was diversified commodity trading. And it grew and grew and grew, and it was a very successful program, very different in many ways to what we do now. Our currency program now is called Kintillo. It was launched in 2000, but the idea is basically the same: systematic trend following.
Tell me, let's just before we jump here, let's go back to the time when you joined AHL. I'm curious here, how much, because we know today that AHL became so important, you could say, in the European history of managed futures. At that time, what did you and the founders of AHL, what did they know about what was happening in the States at that time and the managed futures industry? Because, of course, this is kind of about the same time as the Turtle project finishes, yet there doesn't seem to be a lot of sort of knowledge initially, as far as I understand the story, of what the AHL founders were doing initially and what was happening in Chicago at the same time.
Well, in those days, we basically traded London markets, I think 7 to 12 markets when I first joined, at what we would describe as pretty much sort of, relatively speaking, nosebleed leverage. We modeled ourselves very much on Mint.
Right.
Mint were the heroes for us, and we did believe that if we added more and more markets, gained more and more diversification, and became more and more systematized, a la Mint, then we would replicate some of their success, and that turned out to be true.
Okay, interesting. And so anyway, I was interrupting you, but please continue with your story and what happened following your introduction with Tamizha.
Well, with Tamizha, I had previously noticed, even when I was with Dean Witter in the early to mid 80s, that the large offering we did, and we had what were called the cornerstone funds. We had 3 funds in varying leverages plus Cornerstone 4, right, which was a currency product. Even in those days, the successful CTAs were or tended to be systematic trend followers. The idea of the hot-handed trader was never really something that appealed to me. And my observation, even from the very early days, in those days we had John Henry, there was AO Management, Dinesh Desai, sort of ancient history names, but they were in the main systematic in their approach. And so the idea of AHL very much appealed to me, because the AHL was and endeavored to become more systematic, and that's something that very much attracted me to AHL. And same with Tamizha. I met Tamizha in London because he was a keen opera fan, so he used to come over and we used to meet and share that interest. But he was an extraordinarily systematic trader and a systematic man, and I thought that was very, very attractive and sensible, something solid that I could understand.
And why, or maybe I should ask, what happened at the time at AHL that meant when you started working with Tamizha, you were focusing on currencies early on?
As I mentioned, the belief was that was shared by Bob Tamizha and myself was that the game was becoming too crowded, and so we looked for another game that was not crowded, and that was currencies, right. Entirely bidirectional. And as Bob Tamizha did say at the time, the great thing about currency markets is they're so big that we can't screw them up. Whereas if you look at the history of managed futures, when it bursts its way into a new market, such as LME, which is basically a producers and consumers with a very small speculative interest, when the quote-unquote funds discover that, they tend to upset the balance of it, and it becomes a less, should we say, reliable market from our point of view. Not necessarily from the participants' point of view, but from our point of view, those who are, when the speculative part becomes too big, it becomes sort of out of equilibrium.
It's just interesting because I remember back in the day, you say 1993 or thereabouts, I mean, managed futures were still around a $10 billion industry, so it wasn't a sort of in AUM huge. But I do accept that many times it's been said that CTAs or any strategy is becoming too big for themselves. So I agree that notion can certainly drive you to take go in a different direction.
And I think that's true. It's true now with hedge funds. I mean, you have to question. I mean, how many hedge fund managers does the world need, and could we get by with fewer? My guess is we probably could. I don't know. It's not a subject you brought up at the moment, but I'd point out that at Tamizha we were very successful in terms of returns, asset raising. It was a very, very successful program. At that time, at no time did we have a price feed in the office. And when signals were generated, 7 a.m. New York time, Carol, the lady in the office, would then call Prue, who were our main broker at that time, in London, and speak to somebody called Sid and ask him for the mid-range prices. Sid would give us the mid-range prices, and then the trades would be done, and he'd fax back the fills, and basically we were done for the day. And so when you have that sort of memory of how these things can be done and be so successful, when I hear conversations later on in life about high frequency trading and technology and nanosecond trading systems and this, that, and the other, it makes me feel either extremely old or extremely sensible that we never got involved in that sort of thing, where the margins for success apparently are defined as being very, very small indeed.
I mean, I think it's an interesting subject, and maybe I can tap into your memory a little bit about that before we move on. You say that Tamizha was very successful at the time. Can you put words on why? What made you so successful? What did you do differently, or what did you do just generally that people were attracted to?
I think in our way, we had I'm tempted to say aura, some other people would say arrogance, about us, that due to the leadership of Bob Tamizha, we were driven very much by quality of life. And Bob was a very successful and balanced individual, it always seemed to me. And I would contrast him with some of the frantic, almost foaming at the mouth grabbiness of some managers that I meet now. And I guess that came out in the way that we presented ourselves. As I say, some people saw it as a positive vibe, to give it a modern term, but other people saw it as arrogance. But we were happy with what we did and how we did it. We didn't have any aspiration to take an awful lot more clients on, an awful lot more money on. And remember, in those days, because the internet didn't exist, there was an infrastructure limit to the amount of accounts or in those days bank desks that we could actually trade through. And at one time we were dealing with 12, 14 or so. In this day and age, of course, this is no problem at all. Sure. But back then it was. But Bob specifically was very clear on who he did want to do business with and who he did not want to do business with. And I suppose to some extent we at Inch today, we still have that certain view. I mean, for at the moment, Inch doesn't have any marketing. It never really has had any marketing. If you ask what our biggest single failure is, I would say, well, my biggest single failure is that we are hopeless at marketing. And that dates back to the Tamizha days, where we weren't a marketing operation. We're a manager of money, not a management of people.
Sure. You talk about Bob Tamizha as a great mentor, and I think mentors have clearly become, or they have been very important for certain managers. I mean, when I did my conversation with Jerry Parker, and he obviously talks about his experience through the Turtle program and the mentorship that he had early on from Richard Dennis. What was the most important thing that you think Bob Tamizha taught you?
To show up. Always show up. You win by showing up. Because most people are unable to meet that minimum requirement for whatever reason, one of which might be they were overgeared and simply have to leave the table. Showing up is very important. Bob's best friend was and is Larry Height from Market Wizards One, and Larry Height was very often in our office in New York. Yeah. Larry Height was also a truly great individual, and it was, but entirely systematic. These were not people who didn't represent their greatness by pretending that they knew tomorrow's prices.
Sure. And what, because I seem to remember that there were some joint ventures being formed, maybe even with Height's Group and Mann. So tell me about what happened when you, after a few years with Tamizha.
Well, I think we did a joint venture with Mann, with Stanley Fink,
right?
Who is another superb individual. Of sort of a giant of the industry, as indeed was Larry. Can't say enough good things about him. But we did a joint venture, and in effect, they took over the marketing and other aspects of the Kintyre program. And the reason that they did it was, at the time, our currency program was substantially better than AHL's currency program.
Right.
And if you're representing yourself as a diversified commodity program with X billion dollars under management, well, in effect, you're really not. You're trading an awful lot of indices, an awful lot of interest rates, and an awful lot of currencies, and relatively speaking, not much pork bellies. So if you've got one of those main legs that is a little bit wobbly, you've got a big problem. And so they were on the lookout for a program that was better than or demonstrably better than the one that they were using for currencies at that time, and I think we filled that gap. And so Bob and I basically parted company in no. I think Bob is much older than me. If, despite what you say, there are people older than me, and so I came back to the UK and started a new program under a new company, which was Inch. Relocated it to Switzerland in 2004 and physically moved here in 2006, 2007.
Now, of course, sort of running Inch is a big part of your life today, I'm sure, but I'm just curious, before we sort of dive too deep into other sort of more business related things, what else do you spend your time doing?
On the sort of leisure side, I like to play golf, and I like my cars, and I travel quite a lot to the UK and around the UK, but mostly Scotland. I have a close tie to Scotland. From a business point of view, I spend most of my time getting in the way of the research department, and generally annoy people here in the office. Not so long ago, I had a medical issue, and it both gratified me and depressed me to see that I wasn't missed at all, and that the business ran perfectly well. And some would argue, with a lot of positive evidence, that it ran a lot better without me. So, and being systematic traders, the reality is, we are going to do what the system says we are going to do. There's the good and bad about that. The good thing is we don't have to worry terribly much. We can sleep perfectly well at night. The bad thing is it doesn't make us terribly interesting people. The world, if you watch CNBC or something like that, they have the talking heads there, sort of pinstripe-suited soothsayers and that sort of thing, who are intimating either subtly or not subtly that they have some insight as tomorrow's prices. Well, we, of course, have no insight as tomorrow's prices. So there's a limit to how much we can entice people with what we can intimate. Basically, it is what it is. And that's I did mention earlier, we're not terribly good at marketing, and now you're hearing a perfectly worked example of it. What we will follow the system with discipline and patience and low leverage, and to go back to Bob Tamizha, this will enable us to show up again tomorrow.
Yeah. Obviously, we have many sort of specific topics that I want to touch base on. I'd like to if I can, in an elegant way, phrase a more broad question to begin with. And that is, when you decide to seek mastery in a particular craft, like building a successful asset management business, you can almost call it kind of a quest that you embark on. And for some people, this quest is to bring purpose in their life, for example. But your quest over so many years, what do you think has been sort of what has been the aim or the goal that you've been seeking in that, long career?
Well, first of all, I'd say about Inch at the moment, the fact that Inch is, I suppose it exists or is as big or as successful as it is at the moment, is almost entirely accidental. When I first moved to Switzerland in 2006, it wasn't really the intention to go back into business. It really wasn't. I mean, yes, I took an office, and yes, I got a secretary and that sort of thing, but it really wasn't the intention. It just so happens that we've been fortunate, and people have found us, and the business has grown. So, in answer to your question, on the one hand, there's nothing that drives the establishment and the growth of Inch forward, at least not from me. Nowadays, I would say, I look at some of the people I've worked with, Michael, Mighty, David, other people that other firms who passed through or I've known who are at AHL or wherever, and I see the success they've had. And Inch, I have not had that success. And the reason for that is we're not perhaps as driven as they are to become large. We're not as good at running a business perhaps as they are. We're certainly not as very good at marketing perhaps. Having said that, our numbers are better in terms of performance. So, we've got 1 out of 3 right, but from our point of view, it's probably the most important one. So, leaping back to Bob Tamizha again, we're not unhappy with where we are. In a way, I would say, wouldn't it be nicer if we had just half as much as Aspect or 3 times as much as Winton? But we haven't. We are where we are, and we're happy where we are.
And this to me is obviously what's quite interesting, because as you rightly point out, and obviously I've seen your numbers, so I do agree with you. They look great. This is what's interesting, because to me, and that's partly why I do what I do with these podcasts, and that is to shed light on people where, or at least to encourage investors to maybe find the courage to go and think a little bit outside the norm, and to take a chance, so to speak, on a manager who's not mainstream and not top 10 in size. And let's, help each other to get away from the fact that nowadays most allocations are based on size rather than maybe skill or something else. But anyways, that's just sort of my own motivation, but I agree with you. Right. The first thing I wanted to ask about, and in a sense, it maybe ties a little bit back to what you just said now about sort of organizations, and some organizations have become, very institutional and become very good at that. What about yourself? What have you focused on in building your organization, and what does it look like today?
In Lugano here, we have 8 people. We have 3 on research. We have my partner, Jeff Baker, who's been enormously helpful and influential in the building of the business, not only on the trading side, but on the business side. Pernod Schneider, who is an extraordinarily clever young lady on research. Philip Babbage, who's just joined us. In London, we have Rivaldi, who started off as I think his master's is in aeronautical engineering or some such thing from Oklahoma. So I guess he's about as close as we have to a real rocket scientist. But so I like young people. I like young people who've never worked anywhere else. Mm. I don't want anybody turning to me and say, yes, but this is the way we used to do it at Merrill, because I'm not interested in how we used to do it at Merrill. The young people have good ideas. I like people who manage themselves. As I mentioned, we're managers of money, not managers of people. If I notice that your grandmother has died 3 times and you need to go to a funeral 3 times in a year, then that's probably going to attract my attention. But otherwise, I let people get on with what they want to do. The army term would be delegation is the key to command, and I think that's probably true. I know those other cliches, my door is always open and all this other nonsense, but I don't think we've had 2 people leave us in the last 7 years, both of them involuntary. It was to do with they're having to return to their home country, having completed their studies and visa situation here in Switzerland. And we've had one person that I didn't really ask to leave. It became obvious that they should leave, as is often the case. So our turnover is extremely low, and I think people are happy here. I must say we probably ruin them from working for anybody else because we are not hierarchical in any sense.
Why do you need 2 offices, Chris?
When I go to London, I need somewhere to go because it rains, and sometimes I need to be indoors.
Right.
We have a very, very good young man called Rivaldi Kwan in London, who worked for us here in Switzerland, and because he is Indonesian, he was not permitted to stay here, and I didn't want to lose them. Right. So it does no harm for us to have a representative office in London, and I couldn't find anybody better at all than to ask Rivaldi to operate it, and that's what he does.
Okay. Now, the next thing I want to talk about, I call it track record, but what I really mean by that is obviously your program has been running for quite a while. And with managers, especially I guess in the systematic space, programs, models, approaches, risk management, whatever it might be, changes over time. So before we sort of dive into the strategy, maybe just from a pure track record point of view, if someone asked you, how should I read your track record? What should I focus on? Has there been some major changes, upgrades, innovations, whatever we call it, that I should be aware of? Because in my personal experience, I think people often look at track records and think that they should expect the same going forward. And I would caution about that because, as we all know, people, programs change. And so to some extent, I would almost argue that it's better to look, if you can get it, on a manager's back-tested version of the current configuration to see, what the program is really doing today. But that's very hard information to get hold of. So that's why I'm interested in the whole track record issue, just to bring light on that. How should investors look at your track record if they asked you?
Well, that's an awfully good and awfully big question. First of all, I should say that we present our numbers in 2 different ways. Okay. The first one is without the deduction of any fees. It's a sort of a straight alpha number and without leverage. So it's 1-to-1, and there's no credit for interest. That can be important. Some people say we should add interest, but that would make us look a bit better. So what you're looking at when you look at the 1-to-1 is pure alpha. The other way we show it is, again, without credit of interest, but net of 2 and 20, and at 3 times leverage. Okay. 3 times leverage is as high as we go. The reason being is we like to think that we're going to be staying in business, and 3-to-1 leverage basically gives us the same standard deviation as the S&P 500. Right. But substantially higher returns. So that's why we, as a ballpark, that's as high as we go. Our program hasn't effectively changed in any sense at all over the years. It is systematic trend following. We started off with 10 markets. It's always the majors. We don't do emerging markets. We added a couple of Swissy crosses in, I think, 2008, and then about 2 years ago we added Euro CAD and Euro Australia. So now we trade 16. It should be 7 times 7, 21 crosses, but in actual fact, due to obvious reasons, we only trade 16 of them. in our business, there are four main drivers for a currency system, basically. I mean, we can dance around it a bit and dress it up a bit, but there are basically four main systems, one of which is the interest rate differential, what is now called the carry trade. There is momentum breakout. There is some form of volatility trading, and there's some sort of purchasing parity type programs. Those are basically the four bricks. Excuse me. For our kind of system, is built in the main on interest rate differential and breakout. So you will quickly see that over the last 4 or 5 years, the money that we've made has not been made from carry trade, because with interest rates where they are, there's not a lot to be done there. So any money we've made has come from interest rate differential. So when this goes back to another part of your question, when you look at the full length of somebody's track record, and ours is 14.5 years now, you look at what was possible. Generally speaking, this is a thumbnail thought, but generally speaking, what was possible? Now, and what is possible, what do you get for rolling T-bills? The risk-free rate. What do you get for doing nothing? Yeah. It's the risk-free rate. Okay. Now, at the beginning of this century, we can say that the risk-free rate was, let's say, 4 or 5%, something like that. So if I made 5 times the risk-free rate, your returns are 25%. Today, if I make 5 times the risk-free rate, your returns are what? 2.5%?
Yeah, at a maximum, yeah.
But basically, that there is some equivalency in how you can compare those things. So you as an investor, you have to look at a sort of literally a macro view for this particular asset class. What was doable? What is reasonably doable? What was a reasonable expectation? If you look at the stock market, for example, it's doubled over the last X number of years. Well, that's reasonable. Now, if your manager has done twice as well as that, I guess you'd say, looking backwards, not forwards, but backwards, that's pretty good. Yeah. If he's done half as well of that, you'd say, actually, that's not too good, is it? In our business, what has been reasonable from currencies over the last 4 or 5 years has not been a particularly exciting number. But that doesn't mean it won't be. Sure. Because you invest for tomorrow, not for yesterday. Which is, and something else you mentioned earlier, I think, in our business, that is to say the hedge fund, if that's what we are, managed futures business, if that's what we are, there's a lot of groupieism. Investors like to be seen to be with the new hot-handed guy.
Sure.
So people crash to earth pretty quickly in this business occasionally, and take the investors with them. We've seen that time after time after time. We call it the faster gunslinger syndrome. I mean, if I tell you, for example, last year we were up 20%. You say, 20%? I met a guy last month. He was up 20% just that month. And you'd say, well, okay, but I don't know how many times I've been pushed out of the way by a faster gunslinger, turned the corner, and there he is face down in the street. Sure. And guess what? There's another faster gunslinger coming up again. There's always one. But they tend not to have very long careers.
Sure. So looking at the program today, and as you mentioned, is it fair to, if we're going to try and visualize it, that for the 4 things that you mentioned, that's what a currency program can do, that as long as you know roughly, would you say that those 4... And I'm sort of asking out of ignorance here, but are those 4 categories you mentioned, the carry, momentum, volatility, and purchasing power, are they individually able to produce the same level of return, but at different times, of course?
Yes. Now, what I would say is that over time, by far and away, the most successful of the 4 has been the interest rate differential carry trade. Right. Next would be the breakout, then probably at various times volatility. And there's a danger here, of course, for investors, because currency managers that have done well over the last couple of years, you can almost say, well, you've done well, but you haven't done it on a carry trade basis, have you? And you probably haven't done it on a breakout or momentum type basis either. So you're doing something else. What's left? So you're doing some sort of volatility trade. Okay, that's fine. But is that going to be the environment that is going to present itself tomorrow? So, and a lot of managers, they do continually change their system. And that's fine. They do it for two reasons. One, because they think they're going to improve returns by changing their system. And secondly, more dangerously, is because they sense that this new approach is the approach that, from a marketing point of view, is more likely to attract fresh assets. So you'll see people describe themselves as vol traders. Why? Because they read in the Wall Street Journal that people are writing checks to vol traders. Are they really? I don't know.
It's kind of like when the CTAs start calling themselves hedge funds because nobody likes CTAs.
That's right. That's right. You see, I always said, as you heard me say just now, I don't know if we're a hedge fund. I don't know if we're a CTA. As a currency manager, we have always been basically the red-headed stepchild of both industries. We don't trade futures, therefore we're not managed futures, I suppose. Hedge fund, that's a bit of a misnomer anyway, because there's nothing to hedge. So you tell me. To me, it's a label. It doesn't really matter. But I suppose for allocators, you've got to tick boxes and put you on one form as opposed to another form. It is important, but not to me.
You mentioned the word environment just before, and I think that's an important thing I'd like to dive into a little bit before we move on to maybe the strategy itself and how you go about it. But I think it is important for investors to understand in which environment should they expect a strategy to work. And as you clearly mentioned, for your strategy, the last couple of years, carry would have been very difficult to work with due to what the central banks have been doing. But try and explain to me what the environment has actually been like for a currency program in the last, say, 5 years, from when we've really had intervention, if we can use that word, from authorities, because we know that traditional trend following had been difficult. But how do you then put it into perspective of, say, your strategy in one area of the diversified universe? How do you see the environment and how it's changed and what might change it again?
Well, from our point of view, the environment has not been favorable. Having said that, next to our peers, we've done extremely well. Some of them, FX Concepts, for example, and there are many, many others, have had horrific and fatal periods for some of them. We haven't. We've done pretty well. But having said that, just because we've done well doesn't really mean that it's been ideal, because it has been anything but ideal. With volatility as low as it is, it's been very, very difficult. But as I say, we come in, we show up every day and we do what we do, and we've done okay. We have not changed our system. We do anticipate a return of volatility. That is very, very positive for us and for other trend followers. If they're genuine trend followers, that should be a very good thing for currency managers. I would say that, having been in this sort of period previously, I would say 92, 93, followed by 94 would be a similar period of time. We say in our business, if volatility doesn't rise, it jumps. And a lot of people in our business, I suspect, who have changed their systems may well get caught out by that jump. They will have changed their system to fit with the environment as they see it now, just in time for the environment to change.
Quick question here. You've been around, and you, as you mentioned, you can go back at previous times and say, 92, 93, 94 look similar. And if you just stay with what you do and so on and so forth, things will, go back and models will start producing returns again to levels that you would expect. Now, we hear often, and we certainly heard in the last recent times, that this time it's different. So I would like to ask you if you can explain why these things actually aren't different and why things tend to return to the norm, regardless of the fact that certainly the things that the authorities have done this time clearly they are different. They are using new techniques and new things, but you seem to be under, the belief that that's not going to last forever and the markets will return to how they always behave. Where does that belief come from?
Although the tools that they're using now are, I suppose you could say, are new, I don't think anyone would think that what they're doing is sustainable. That is to say, they cannot continue to do it. And indeed, if you look at the Fed, they're not. They're cutting back on QE and this, that, and the other. Currency markets are different to most markets, or to any other market, I could say, because they are completely bidirectional, which makes them ideal markets for the popular press phrase would be sort of currency wars or competitive devaluations or competitive rate rises or whatever it is. And because of the tools that have been used, not in spite of, but because of the tools that have been used, I can easily see that not only will the environment looking forward become more favorable, it'll become very much more favorable and very quickly. I just don't know when that very quickly will start. It may well have already started. I don't know.
But just again, just to for the benefit of the listeners here, why do you say that it's going to be even more favorable? What is it in that statement that you feel that the markets and let's take currency markets, which obviously is your expertise, what is it about them that it kind of, it's kind of a cycle, isn't it? That where, if you stretch the rubber band too much, then you're going to have an even bigger move when it comes back. Is that what you see in currencies, that they can do whatever they want for a period of time, but once they, let go, things are going to be even better, and we're going to have, above normal returns for a period of time. Now we've had sub returns for a while.
Well, first of all, I say that the potential for substantially higher returns exists. Yeah. Whether or not we, Inch, will be able to participate in those successfully, I don't know. I couldn't make that representation. But what the action of the authorities has done is they have certainly put us in uncharted territory, not only for us, but also for them. They have also, from a sort of my observation, the toolkit is a little bit bare, or you could say another way, they're sort of running out of ammunition. Generally speaking, another sort of broad observation would be that central bank intervention itself, in the currency markets at least, hasn't been particularly successful. When you take a step back and look at it, you see the Australian, the Japanese interventions recently. This is not something that they can slow it down, and they can sort of reverse the move for a short period of time. But once they've actually intervened, then the trend that was established before the intervention resumes, and on it goes. So I don't think central banks are, to the market, least of all the currency markets, as scary as they were way back in the 90s, for example. And less so now, given the extraordinary interventions, and I mean sort of tools that they've used that have, I think, increased the risk of exactly what they hope to avoid.
I want to go and talk about the program itself, Cantillo, and would like you to describe how you've structured it and so on and so forth. But before we go there, I wanted to ask you if there is a particular objective with the program. Now, obviously, one objective could be just to say, well, we want to make money every year, but there could also be other objectives. For example, there could be certain periods of time where you want to make money or be more certain that you make money. Is there any objective in your design of the program that you've tried to achieve?
Now, the answer to that is no.
Okay.
The system is, in fact, designed to produce absolute returns. So after many, many years, we've been able to do that, and from that we've been able to make a number of observations. For example, it has a very strong positive benefit to an equity portfolio. Our positive months seem to happen at a time when the equity markets have negative months, and on it goes. So the benefit of including our particular program, and I assume other similar programs in a portfolio that is otherwise predominated by equities is quite pronounced. Now that's something that wasn't designed to do that. Sure. It just has.
Why do you think that is? Because it's not sort of it's not sort of a natural conclusion I would have drawn that if you just trade one asset class, that would actually have a particular correlation to another asset class, in particular when we're dealing with currencies where, as you said, you're dealing with, every time we have a currency pair, we're dealing with two different countries, so to speak, and their economies. It would have been easier for me to assume if you were trading equities themselves and you just have some models that would react very quickly when markets started to fall. Why do you think your correlation have been as it is?
I really don't have a direct answer to that. Okay. I really don't know. In fact, what I've just said is an observation, a factual observation. It wasn't created to do that. It just has, and it's a very stark benefit it has to a equity portfolio. I would say that one of the reasons might be is that currency markets are first and foremost markets of capital flow. So I guess if people are selling stocks, they're putting it in a currency, and people are buying new businesses or selling businesses or investing or divesting on a sort of a much larger scale than simply buying, Widget PLC or something like that. So perhaps that's got something to do with it. But in any event, and whatever the reason, it is a pronounced fact.
You mentioned that you were trading sort of the G7 currencies, and you're obviously pairing them up. But the currency markets have kind of changed in the last 20 years, certainly with the introduction of the euro and other things. How has liquidity, I'm just curious here, how have you observed liquidity in the foreign exchange markets in recent times? People talk about equity volumes being at the lowest level for many, many years and so on and so forth. But what does the interbank market in currencies look like nowadays?
Well, we only trade the majors. So we don't trade any of the so-called emerging or submerging currencies. We just basically trade the main currencies crossed against each other. So it's 7 times 7, 21. As I mentioned, we trade 16 of those. We trade very infrequently, relatively speaking. Our winning trades are held on average for about 16, 18 days or so, and our losing trades are held for 6 days on average. And that's been the case over the full period of the track record. So liquidity and transparency are amongst the most important attributes that any market can have. And in fact, I remember Dean Witter 100 years ago, they would always, I think there was a list of 7 characteristics that a market must have in order to become considered investable. I've forgotten what 4 of them were, but the first 3 were liquidity, transparency. I've forgotten what the third one is as well. But the point is that the currency markets are blessed with liquidity and transparency to a far, far, far greater degree than equity or fixed income markets.
Do you trade futures or do you trade the interbank market? And the reason I ask is that with the recent crisis, we know that banks became much more suspicious of each other, let's put it that way, and maybe didn't trust large lines and dealing facilities with each other. How did you experience that, or what were your experience with this?
Well, we just trade spot. Okay. So for our business couldn't be more simple and straightforward. Okay. Although I suppose you could say it is a derivative business, it is a pretty child-proof derivative business compared to some. So we haven't experienced any issues at all in that regard.
Sure. Tell me about, if you would, can you take me through the program, the structure, the sort of overall look and feel of it, and how you sort of divided into maybe different types of models and their function, so to speak?
Okay. Well, I've mentioned the 4 types of. But you forget volatility and forget purchasing power. In the main, most currency programs like ours are made up of interest rate differential and momentum breakout. Ours is about 70-30, favoring interest rate differential. It is a matrix. One of the things I think we probably do that's slightly different is that we don't regard the crosses as currencies per se. If I say to you, for example, dollar yen, you're immediately going to start thinking about Japanese exports and Abenomics and all of this, that, and the other. Well, of course, the computers don't see that. They just see a row of numbers that have or have not changing relationships with each other in terms of volatilities or correlations or whatever. So what we have is 16 rows of numbers. And we try not to think about the computers do not think about them in terms of being countries, if you will. They're just rows of numbers. When we put on a trade, and our systems is entirely probability based. And the reason it's based on probability is because we are not predictive in any sense. We have no idea what tomorrow's prices are going to be. I wish we did. If we did, we wouldn't be having this conversation.
That's right.
But we don't. And so at the time of instigation, all trades are risk equivalent. And the reason they are risk equivalent is precisely as I've said. If we knew that this trade was better than that trade, we wouldn't make that trade. We just make twice as many of this trade. But we don't know. So all trades are risk equivalent at time of instigation. What will take us out of a trade is an increase in volatility, both on the upside and the downside. High volatility tends to terminate a trend. Low volatility tends to initiate a trend, generally speaking. And so that's the way our system works. So if we look at some of the positions at the moment, we see that we are long 2 risk units of dollar yen. We went long on the 1st of September at 104.293, and it's currently 109.226. So that's been a successful trade for us. We have a losing trade. We are long 1 risk unit of Euro CAD at 141.82, and it's currently 141.52. So that's a losing trade. Each of these trades have their own trailing stop, which is based on time and volatility, which hopefully keeps us out of trouble when volatility in that particular trade does pick up. As I mentioned, high volatility tends to terminate a trend. Low volatility tends to initiate a trend. We are extremely low geared. It ranges from 1-to-1 to 3-to-1, and the reason for that is that you'll always make, as David Harding used to say at AHL, you'll always make money in this business if you don't go broke first. What is going to make you go broke? Leverage. So if you intend to be in a position to show up again tomorrow, you've got to keep your place at the table, and that means you don't lose all of your money, no matter how certain the trade looks. We trade entirely systematically, entirely disciplined, because, and I think most people can identify with this, whether they tend to use the information or not is their choice, but our observation would be people lose money for 2 main reasons. The first is emotion, hope, greed, and fear, bad inputs for a trading strategy. And the second is ego. If you get something right, you might bet a little more. Now you know something, get 2 things right, suddenly you're a genius and you're on CNBC. Now you're going to increase your gearing and you're a truly, truly dangerous person. So if you can remove emotion and ego through a set of rules, which is what we do, then you've already got an advantage over other investors. At least that's the way we see it. We don't claim that we have any predictive or special insight at all. We leave that to others.
Is it the same models that trade all 16 crosses?
No. Interesting enough, the Tamizha program was. unbelievably enough, in those days we traded forwards and we traded 28 different crosses with one algorithm. It was a one-size-fits-all algorithm.
Wow. Okay.
Unbelievable, but that's what we did. Quintillo is a lot more sophisticated. Each of the 16 crosses has its own algorithm. People these days get terribly excited about the word algorithm and think you're a really clever chap because you've got an algorithm. But an algorithm is simply a set of rules.
Sure.
That if you have a set of rules, you either follow them, in which case you have a set of rules, or you don't follow them, in which case you don't have a set of rules.
Yeah.
We do follow our rules. So we make no representation to anybody other than the fact that we will follow the rules that we've set out.
So is that to be understood that there's kind of one, and let's just call it a model. So a set of rules becomes a model. So there's just one model for each currency pair?
That's right.
Wow.
Well, the model itself is made up of different component parts.
Right.
But it's like anything else. It's like a machine or a car. The more moving parts you have, the greater the probability, that word again, probability of breakdown.
Sure.
So you can, and I think in our industry generally, there's a sort of a love affair with perceived cleverness, which is certainly not requited, but it's certainly not terribly helpful, I think. We are in love with cleverness when simplicity should be found to be more attractive, in my view.
No, I completely agree. But tell me, what could be the difference between two models then? In the sense that once you start deviating away from trading one model across all markets, you always have the nudging question about optimization and so on and so forth. What would be the difference if you sort of should visualize it between the algorithm you use for one currency cross and the next one?
The parameters would be set differently. So, for example, there'll be a couple of instances. For example, the parameter that measures or defines volatility for one cross would be different to another cross, and that, of course, builds to the risk equivalency of the price streams, if you follow me.
So the principle, in a sense, is the same, meaning that you're looking for some kind of breakout as the main methodology in this case. Yeah, absolutely.
And they are remarkably simple. I think people would be either surprised or appalled at how simple the rules actually are. They're encoded in computer speak because it's more efficient for us to do this. But certainly with Kintyre, the Tamizha program, you could literally write it out and work it out by hand if you had the interest and the time. Quintillo is slightly more complex than that, but not much. Because you come into a point where, and I speak on a lot of panels and meet a lot of people, and they tell me how terribly clever their system is, and to which I always say, well, could you write it down on a single sheet of paper for me, because I'm not terribly bright. Well, no, it's you don't understand. Well, anytime anybody tells you that you don't understand, it means you probably do.
Sure. And
what it means is that they've convinced themselves that they're very, very clever indeed. We haven't. We're very simple indeed. We describe ourselves as not the genius, but the idiot savant. We don't know very much about anything, but what we do know, we really do know.
I feel I have to deviate a little bit here and ask you a question, because I think it's so important to understand, and that is, what do you think the larger managers with the 50 or 100 PhDs, what do you think it is that they do actually? Because performance-wise, sometimes, not always, but sometimes, it's very, very difficult to tell the difference between a firm that has 50 PhDs and the firm that has one PhD or non-PhD. What do you think that actually they do, other than creating more capacity? I do understand that can be a big part of research, is to find out how do we execute 10 billion. That I understand. But what else do you think that they achieve with all this research?
The answer to that is I don't really know.
Okay.
There are one or two very, very good examples of firms that are extremely well run from a business point of view, from a research point of view, from a trading and execution point of view, who you would say is a level of genius, and they're brimful of PhDs.
Yeah.
I would speak of Winton, for example.
Yeah.
You would think of, should we say, some others which I won't name, who are sort of wannabe Wintons, who's might come out of the blocks looking like geniuses, but soon stumble and fall on their face and just look a bit silly for all the semi-intellectual nonsense that they've spewed forth. And why? I don't know. You'd have to ask them. I really don't know. The cleverness. You see, Tamizha would say, and Larry Hyatt would say, this is an extremely easy business. There's nothing to this business because you keep scoring dollars, and you get a printout every night. Are you up or are you down? A black number, red number, plus sign, minus sign. This is not hard. Now, you might have all sorts of reasons as to why the number isn't as big or is a minus number, whatever, but it doesn't change the number. And it's the same with prices, for that matter. You hear people talk about price of the stocks or whatever it is. Well, that's all very well and good. You might think the price is wrong, and you often hear people say, "Oh, the price is wrong." Well, we have a view on that. You might think the price is wrong, and you might be right. It might be higher or lower. It doesn't matter. The fact of the matter is, it doesn't change the price.
Sure.
And what do these PhDs do? I don't know. Maybe they argue with the price.
I wanted to go back and ask you about your models, because you mentioned the fact that you're a trend follower, but you also mentioned the fact that volatility and increase in volatility, and I want to make sure I understand it correctly. Can increase in volatility completely cause an exit of that model? Or is it a reduction of position size? And the reason I ask that is because we know, of course, that trend following as a general rule means that the trend actually has to change before you get out. So you kind of, so I just wanted to see whether there was a bit of a twist here on when you talk about trend following, that in fact it's trend following, but it's kind of with a chance, or at least to actually get out during the trend because of changes in volatility rather than a price change.
The volatility is generally speaking what takes us out. Okay. One of the problems we've had over the last year, I suppose, 11 months, is that volatility has been so low, it's resulted in us being in all 16 trades all the time.
Right.
Now, the average holding period for a losing trade has remained the same. It's 6 days. But the holding period for a winning trade has dropped from 16, 18 days down to about 6 days as well. So that's the sort of the statistical definition of the trend follower's nightmare, which is getting whipsawed.
Yeah.
Now, over this last month, we've noticed that we are now getting taken out of some of these trades. This is brilliant. This is excellent, because now, for example, instead of having 16 trades on, we have 12 trades on. This shows to us that volatility is slowly returning. And this is an environment in which is more acceptable and more amenable to our type of system. I can't speak on for other people who describe themselves as trend following, but certainly from our point of view, this is a positive development.
Sure. So just to confirm, so each of the 16 markets and therefore or crosses and therefore models, they work completely independently. So all 16 could be involved, or that they're, so if it's to do with the euro, so there is no overriding exposure limit on that.
No.
In that sense. Okay.
No, because each price stream, we call them currencies, each price stream has its own characteristics. Which vary for time, and that consequently has its own stop, and the stop, as I mentioned, is based upon volatility. So the volatility of euro yen is entirely different to the volatility of euro dollar, for example.
I mean, you've looked at obviously many different indicators over time, I'm sure, and I'm just curious in general. I mean, again, if we were going to help sort of the listeners and maybe the people who are aspiring to become a manager of funds at some point in their career, are there any indicators that you feel are more robust?
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.